Hi everyone, I'm Aura Ogurian with ACap Advisors and Accountants, and welcome to another edition of the ACap Recap, where we go behind the blog and give you quick financial and tax tips. These are questions we get from either clients or prospects about hot topics that they want answers to. And in today's episode, we're going to talk about restricted stock units or RSUs. If you're not familiar with RSUs, well, stay tuned because we're going to do a deep dive into them and explain how they work and the taxation of RSUs. But before we begin, remember to like, subscribe, and share our channel. And if there's a topic that you want us to cover, be sure to include it in the comments section below or send us a message and we'll make sure to cover it in a future episode. Hi everyone, welcome back. Now let's first define what is an RSU, a restricted stock unit. An RSU is a form of equity compensation that's given to employees to not only incentivize them to stay with the company, but also incentivize them to help the company grow, because the higher the company grows, the more valuation it has, the more value that RSU is also going to have. Now, there are a lot of different types of equity compensation structures out there. There are incentive stock options, non-qualified stock options, restricted stock, share appreciation rights. There's tons of them, which we'll cover in a future video. But today, what we're going to focus on is only the RSUs, the restricted stock units. And we're going to do that by giving an illustration of someone working at Google. We're going to assume that you work at Google and you have some RSUs issued to you. Now, Google is not the only one that issues RSUs, of course. There's a lot of companies that do it, but we're going to use Google as an example because it's the most widely known company out there. Now let's talk about some of the key features of the RSU once you get your offer letter. When you're going to get your offer letter, it's going to have a schedule of when your RSUs vest. Vesting, as I mentioned earlier, is when you're entitled to these RSUs. Now, one of the benefits of the RSUs is that they almost always have value to them. Unlike a stock option that could potentially go to zero, even if the company still exists, if the price that on the stock option, if the price that you're about to pay for the stock to purchase it is way more than the actual price of the stock currently trading, then it has no value. But on an RSU, it's going to almost always have value unless the company goes bankrupt. So that's one of the benefits of the RSUs. The other thing you'll notice in your offer letter is that you're going to have a vesting schedule. Now, there are two types of vesting schedules. There's a graded vesting, which is what we're showing here, and also there's a cliff vesting. A graded vesting is essentially you're entitled to a certain portion of your RSUs vest every year. So in this example, 20 units vest every year for the next 5 years. In a cliff vesting, for the first 4 years, you don't have any units that vest, but on the 5th year, they would all vest. So that's the main difference between a graded and a cliff vesting. Most of the time you see a graded vesting and not so much a cliff vesting. The other important aspect is if you lose your job, most of the time, now there are some exceptions, but most of the time your vesting stops. So you don't, anything that you have not been entitled to yet, anything that has not vested yet will stop immediately. So for example, in this situation, let's assume you stop working at Google after year 2, then you're only entitled to that first 20 units of stock that you had vested for you. And then the most important key feature of RSUs is that when you have them issued to you, there's no tax implication. Now, this is very important because a lot of people think when they get their stock or their RSUs issued that there's a tax implication, but that's not the case. Taxes only come into play once they vest, which we'll go into an example of that later on. So let's quickly look over what happens here. Let's assume it's May 1st of the first year of year 0, and you just started working at Google. You don't have any shares that have vested. 1 year from now on June 1st, you're going to have 20 units or 20 shares vested, and those vested units are going to have an expiration of 10 years out of the June 1st of 10 years later on. After the second year, you're going to have another 20 units that are vested. And it's going to continue to happen until the 5th year when you have all 100 units of those stock vested. Okay, so now that the 1 year mark is over, let's assume that you have these 20 shares of Google stock that vest. Now, what happens on the actual vesting is June 1st, now it becomes a taxable event for you. So it's June 1st on the second year, and you've got these 20 units that vested. On June 1st, let's assume that the price of Google is $3,000 a share. Okay, and you have these 20 units that vest. On that paycheck, you're going to have reportable income of $60,000, which is the price of Google at the time on that day times the number of units that you have or number of shares that you had vested. So you have $60,000 of reportable income on your paycheck for that pay period. And it's also going to be reflected on your W-2. Later on, we're going to show how that's going to show on your W-2. But on that one particular paycheck, you're going to see $60,000 of additional income. Think of this just like a bonus, like a cash bonus, even though you're not actually getting the cash, you're getting shares of Google stock. It's the equivalent of getting a cash bonus. Now, what happens in addition to getting this on that one paycheck? What's also going to happen is you're going to be subject to payroll taxes. Now, payroll taxes are a combination of Social Security and Medicare. Social Security is 6.2%, and there's an annual cap of how much Social Security wages that you're subject to, and that changes every year. But there's no cap on Medicare. So Medicare is 1.45%, and you can make millions and millions of dollars a year. You're going to owe 1.45% on those, whatever amount of money that you make. So in this situation, of the $60,000 you have of reportable income, you're going to pay $37.20 in Social Security tax, and we see it's 6.2% times the $60,000. You're also going to pay $870 of Medicare tax, so $60,000 times a 1.45%. Now, those are just the payroll taxes. In addition, you're going to have income tax withheld. It's going to be federal income tax withheld, state income tax withheld, and then there's also going to be supplemental wages or supplemental taxes that are withheld, which I'll describe in a second. So the federal income tax withheld is going to be based on what your W-4 is. When you first started working at Google, you will have to have submitted a W-4 on a federal, and then the equivalent of whatever state you're at, their W-4 equivalent. And the purpose of that is for the employer to know how much of your taxes to withheld every paycheck. And in this case, I'm just going to use an arbitrary amount of 20%. You have 20% of the $60,000 that's withheld. That's going to be withheld from your paycheck. And I'm going to use an arbitrary amount of 10%. It's kind of on the high rate, depending on what state you're at. That's going to be $6,000, so 10% of $60,000. Now, the supplemental wage rate is going to be based on how much your total compensation is for that year. If it's under $1 million, typically it's 22% supplemental withholding. If it's over $1 million, it's 37%. And this is kind of the reason why when someone gets a bonus, they think their bonus is taxed more. It's actually not taxed more. It's the withholding on that bonus that has a supplemental tax on it. That's a supplemental withholding. It's not a tax. It just means they withheld a little bit more of it. So that way later on, you're not going to have a big tax bill. And I'm going to have a separate video on supplemental taxes or withholdings, but I'm just using this to show you what your total taxes are going to be from this first vesting tranche that happens on the first year. So in this case, the total taxes that are withheld are $35,790, and it's the sum of the withholdings, federal, state, and the supplemental, plus the Social Security and the Medicare tax. That comes out to $35,790. The net proceeds of this vesting comes out to $24,210. And I did that by subtracting the reportable amount, the $60,000, less the total taxes that are paid. Now, you have the option of either paying these taxes separately, which very few people do, or the company essentially withholds some shares to pay for those taxes, and then they give you the net amount of shares that are remaining. So in this case, we calculated that about 11, almost 12 shares are going to be withheld. And I did that by taking the total amount of taxes that need to be paid divided by the price of Google on that date, and it gives us the approximate number of shares that need to be withheld to to pay for the payroll tax. Then that leaves us with the net amount of shares that are going to be deposited into your account. Typically, companies have a brokerage account that they set up for you where these shares are going to be deposited into. So let's say if it's E-Trade or Schwab or Fidelity, the net amount of shares, this 8 shares that you're going to have, are going to get deposited into this brokerage account that's going to be set up for you. Now, what happens after that, we're going to talk about that next, but this gives you an example of what happens when the shares vest, what taxes are paid, what taxes are withheld, and why you have such taxes withheld, and why the number of shares that you actually get is less than what you actually had invested. Okay, so it's now the end of the year, and the end of year 2, you've gotten one tranche of your RSUs that have vested and nothing else has happened. You've got your regular salary. Let's see what the results look like on your W-2. So on the right side, we see that we have a fictitious W-2 for Bob Sacramento. And then on the left, we have the vesting of the 20 shares of Google that you had in June 1st of the year. So let's assume also that your regular base salary was $100,000. So how would this look on your actual W-2? So we have a W-2 here in box 1. You'll see that you have $160,000 of compensation. Of that 160, you have your $100,000 of base salary. And then you'll see in box 14 that there'll be a code that says $60,000 of RSU income. So that's where it shows that you not only had $100,000 of base salary, but you also had $60,000 of RSU income that we calculated earlier. And you can see on the left-hand side here how we came up with that $60,000. On the box 2, you'll see that $50,000 of federal income tax withheld. That's going to be a combination of what was withheld from your paycheck throughout the year, but also the withholding that was done on the left-hand side, the calculation where you see that $12,000 that was withheld, plus the supplemental wage of 22%, supplemental withholdings of 22%. So it's the sum of this 13.2 and the 12. What you'll also see is in box 3, there's a Social Security wages that's different than box 1 wages. And that's because, as I said earlier, Social Security wages are capped every year and it increases every year, but Social Security wages are capped. And in 2021, they were capped at $142,800. Now the tax on that comes out to $88.54, which is 6.2% of the $142.8. Medicare taxes, as I mentioned earlier, are not capped. So the maximum tax on Medicare could be unlimited, but it's 1.45% of the Medicare wages, which in this scenario comes out to $23.20. You'll see that we assume there's no 401k contributions, no employer paid healthcare, which would all be shown in boxes 12A, B, C, and D, and so on. Also, I assume there's no state withholdings, which is not the case because most likely you're living in a particular state. But for the sake of simplicity, I didn't put anything in box 15, 16, and 17. But usually what you'll see there is the state of residence. So in this case, wherever Bob Sacramento lives, the company's employer state ID number, that's essentially like the EIN for the company for that state for payroll taxes, the wages that are allocable to that state, usually it's the same wages that you see in box 1, and then any state income taxes withheld from the employee paycheck during that time period. But the important thing here is what we want to show is how the RSUs show up on your W-2 at the end of the year. In this case, you'll see it's included in box 1, but then it's separated out in box 14. And sometimes they might have it on a separate page, but usually there'll be a note in box 14 that says, see separate page for a breakdown. So to recap, an RSU is a form of equity compensation that's given to an employee as a way to incentivize them to stay with the company, but also to help the company grow over time. As I mentioned earlier, RSUs always have value as long as the company's still around. So unlike a stock option that could potentially go underwater, meaning if the stock price is a lot less than what you have entitled to buy it for, that it's not worth any money, an RSU will always have value because whenever it vests, that's the value of that RSU. Also, there are no tax implications when the RSU is issued. So when you first receive the RSUs, there's no tax implication. The only tax implication that occurs, actually two instances, is when it invests. When it invests, you have ordinary income, as we saw earlier, and the ordinary income shows up on your paycheck and then later on your W-2. The other tax situation that might occur is when you sell the stock, because now that you actually own the stock after the stock is vested and you've got those net shares in your account, then you have the choice of either selling the stock, and if you sell it within a 1-year time frame, you have short-term capital gains or losses depending on how the stock is done. Or if you hold it for more than 1 year, then you have long-term capital gains or losses, again, depending on how the stock is done. So thank you very much for joining us for another edition of the ACap Recap. I hope you enjoyed this episode. If there's a topic that you want us to cover, be sure to include it in the comment section below. Remember to subscribe, like, and share our channel, and send us a comment and give us a thumbs up. Thank you.